Welcome back to the show. In Britain, shares of Barclays Bank dropped 6% after it announced plans to raise $9 billion. So what does the bank plan to do with all that money? Richard Bestic has the details.
Barclays will issue nearly $9 billion in new shares to meet a shortfall in what banks call a leverage ratio, the amount of capital held in reserve against the bank's total assets. Barclays reported it held just 2% in reserve. In June, the regulatory body of the Bank of England, the Prudential Regulation Authority, said banks need to hold 3%. Barclays will issue $8.9 billion in new shares to help reduce a total shortfall of around $19.6 billion. The cash, designed to protect the 320-year-old bank against shocks to the global financial system, like the one in 2008. In addition to issuing $8.9 billion in new shares, the banking giant will also issue more than $3 billion in bonds.
What we've announced is a bold and decisive plan to fill that gap through a series of measures. Firstly, of course, the equity raising, then contingent capital, retained earnings, and of course balance sheet reduction. It's the right plan at the right time.
The market reaction to the news: Barclays' share price dropped, even though the company's half-year pre-tax profits were double last year's. The cost from last year's LIBOR rate rigging scandal may have factored in too.
No one's handling the clean-up, as far as the bank's concerned, brilliantly yet, but I am starting to hear the right language about putting things right.
The Bank of England has endorsed the measures taken by Barclays as credible.
However, as they'll tell you here at Lloyds Bank, the Barclays share issue isn't entirely consequence-free. This bank was bought by the British taxpayer in the financial crash, and it's now feared that the government plans to sell its shares could be hampered by the big Barclays sale. Richard Bestic, CCTV, London.